Every Friday, most people wait for a paycheck from their boss, but imagine if your portfolio paid you instead. That's the power of high-yield weekly dividend ETFs. These aren't your typical funds that drip out 1% or 2% a year. Some of them are delivering massive double-digit yields and sending investors cash every single week. But the challenge for income investors is finding the right dividend yield without sacrificing your principal. Many ETFs promise high dividends, but they suffer from NAV erosion or unsustainable payouts. That's why it's so important to understand which funds can truly deliver consistent, reliable weekly income. In this video, I'll walk you through 5 weekly and monthly dividend ETFs that stand out for their high yields, unique strategies, and payout consistency. I'll cover how much they pay, how often they distribute, their recent performance, expense ratios, and the features that make each one different. By the end, you'll know which ETFs could fit your income strategy and which one deserves a spot in your portfolio. If you found this video helpful, don't forget to hit that like button, subscribe, and share it, which helps us reach more dividend ETF investors. Quick reminder, this video is not intended as financial advice. Investing in dividend ETFs is risky. Always do your research before making any decision. Kicking off the list is QQQI, one of the most popular weekly dividend ETFs tied to the tech-heavy NASDAQ 100. What makes QQQI stand out is its strategy. It writes covered calls on some of the market's most powerful growth names. Think Apple, Microsoft, Nvidia, Amazon, and Tesla. By selling options on these household giants, the fund collects premium income and distributes it to investors in the form of weekly dividends. The result? Yields that can push above 30% annually, paid out like clockwork every single week. For investors who want both tech exposure and consistent income, QQQI has become a go-to choice. Instead of waiting for quarterly payouts from individual companies, you're effectively harvesting the volatility of the NASDAQ 100 and turning it into a paycheck. Now let's talk performance. While the share price doesn't always keep pace with the explosive upside of the NASDAQ itself, because the call writing strategy caps gains, the total return remains highly competitive once you factor in those oversized distributions. Investors who reinvest dividends have seen impressive compounding, while those who take cash out enjoy a steady income flow without having to sell shares. The expense ratio comes in at around 0.68%, which is higher than that of a plain index ETF like QQQ, but that's the cost of the income strategy, and most income investors find it justified, since no traditional ETF is handing out weekly distributions at this level. What really makes QQQI unique is its balance. It gives you exposure to big tech's upside potential while smoothing out volatility with regular option income. In other words, you're still participating in the innovation-driven NASDAQ, but with the added benefit of a consistent paycheck rolling in every Friday. If you want weekly income and a front-row seat to the growth of the biggest tech names on Wall Street, QQQI is one of the most powerful high-yield ETFs to start with. When it comes to income-focused investing, few funds have made as much noise in such a short span of time as the NEO's S&P 500 High-Income ETF SPY. Launched in 2022, SPYI has quickly carved out a niche for itself by promising what many investors crave: double-digit yield and monthly income. However, as with all things on Wall Street, that promise comes with trade-offs that are worth examining closely. At its core, SPYI is built on the familiar foundation of the S&P 500, holding the same blue-chip companies you'd find in a traditional index fund like SPY. The twist comes in its strategy. Rather than relying solely on dividends, SPY layers on a sophisticated options overlay, selling and buying S&P 500 call options. This covered call approach generates option premiums, which are then distributed to shareholders. The result has been eye-catching, a yield hovering near 12% annually, paid out every single month. For retirees or income-hungry investors, that's a hard headline to ignore. The numbers look impressive. Over the past year, SPYI has delivered investors more than $6 per share in distributions, translating into a trailing yield close to 12%. Since its inception, total returns have been solid, at around 49%, although they lag behind the broader S&P 500, which returned closer to 67% over the same period. That gap highlights the unavoidable cost of SPYI's strategy. Upside is capped. In bull markets, when equities surge, SPYI's option overlay acts as a ceiling, limiting gains in exchange for steady income. And then there's the sustainability question. A closer look at SPYI's payouts shows that the vast majority, nearly 98%, is classified as return of capital. On the surface, this can be tax-advantaged, as it reduces your cost basis rather than subjecting you to ordinary income. But it also signals that the high yield isn't flowing naturally from dividends or net investment income. Instead, it's largely a product of option premiums and portfolio management decisions. If market volatility subsides or option pricing weakens, those lucrative distributions could shrink. Costs are another factor. SPYI charges an expense ratio of 0.68%, which is steep compared to passive index funds. Investors are effectively paying for the active management of the option strategy, and while the yield may justify that, it's something to weigh against lower-cost alternatives. The natural comparison is GPI, JP Morgan's Equity Premium Income ETF. Like SPYI, GPI uses covered calls to generate income, but its yield tends to sit closer to 6 to 8%, and its expense ratio is about half as much. JEPI may not offer the same headline-grabbing payout, but its balance of income and growth, and its lower cost, has made it a popular choice for conservative investors. On the other end of the spectrum is SCHD, the Schwab U.S. Dividend Equity ETF. With an expense ratio of just 0.06% and a yield of around 3 to 4%, SCHD doesn't promise massive monthly checks. Instead, it focuses on long-term dividend growth and capital appreciation, making it the favorite of those who care more about compounding wealth than maximizing income in the short term. So, where does that leave SPYI? For the investor who wants monthly cash flow at almost any cost, it's a compelling option. The distributions are generous, the income is consistent, and the S&P 500 Foundation provides familiarity. But it's not without risk. The capped upside, the reliance on options premiums, and the high management fee mean SPYI works best as a niche allocation rather than a core holding. For many, a blend, SPYI for income, SCHD for growth, and JEPI for balance, might be the more prudent formula. In the end, SPYI proves one thing clearly. There's no free lunch in investing. You can have a high income, but you'll sacrifice upside. You can have low cost, but you'll give up yield. The real question is which trade-off best fits your portfolio. For our third pick, let's shift gears to something far more traditional: VOO, the Vanguard S&P 500 ETF. Unlike QQQI, which thrives on volatility and option strategies, VOO is about as classic as it gets. It tracks the S&P 500 index, providing investors with exposure to 500 of the largest U.S. companies. What sets VOO apart is its stability, ultra-low cost, and long-term reliability. With an expense ratio of just 0.03%, it's one of the cheapest ETFs on the market. That means more of your money stays invested and compounds over time, rather than being eaten away by fees. The dividend yield here is modest, typically ranging from 1.3% to 1.6% annually, paid quarterly. However, the real story with VOO is its impressive track record. Over the past decade, it has delivered double-digit annualized total returns, driven by the growth of companies such as Apple, Microsoft, Amazon, and Johnson & Johnson. While it's not designed for eye-popping weekly payouts, VOO is one of the most trusted wealth-building ETFs globally. So why include it in a list of high-yield weekly dividend ETFs? Because many investors pair VOO as the core holding in their portfolio with higher-yield option income ETFs, such as QQQI or SLTY. Think of VOO as the anchor. It's steady, reliable, and designed to grow your wealth over decades, while the other ETFs provide the weekly income boost. Together, they strike a balance between risk and reward. What makes VOO unique is its simplicity and scale. For investors seeking long-term stability alongside aggressive income strategies, VOO serves as the foundation that keeps everything balanced. Coming in at number 4 is YMAX, one of YieldMax's flagship weekly dividend ETFs built to squeeze income out of some of the market's most innovative and volatile names. Unlike broad market ETFs like VOO, YMAX is designed to deliver high-yield cash flow by writing covered calls on a basket of disruptive tech stocks. Think of companies tied to AI, EVs, cloud computing, and other next-gen themes that dominate Wall Street headlines. What makes YMAX so appealing is the weekly payout frequency paired with annualized yields that often exceed 40% or more. For income investors, that's like turning volatility into a consistent paycheck. Instead of waiting months for dividends, you're harvesting option premiums generated from some of the market's most exciting sectors. Performance has been solid relative to its strategy. While share price growth is naturally capped due to call writing, the total return shines when distributions are factored in. Investors who reinvest their dividends experience compounding effects, while those who take cash out enjoy a reliable income without having to sell their shares. The expense ratio hovers around 0.99%, which is higher than traditional funds like SCHD or VO. However, for a specialized weekly income product, this is pretty standard. Most income-focused investors consider it a fair trade-off for the unique exposure and payout structure. What sets YMAX apart is its focus on innovation-driven volatility. Rather than relying on slow and steady blue chips, YMAX capitalizes on the hype cycles and momentum swings in sectors such as artificial intelligence, semiconductors, and fintech. That means higher premiums, higher payouts, and bigger opportunities for aggressive income investors. Of course, the trade-off is risk. If the underlying innovative names stumble or markets turn sour, distributions can shrink. However, for those who believe in the long-term growth of disruptive industries, YMAX offers a bold way to generate substantial weekly income while staying at the forefront of the future of technology. Rounding out our list is HOOY, one of the most surprising stars in the weekly dividend ETF lineup. This fund is tied to Robinhood markets and utilizes an option income strategy to convert the volatility of Robinhood stock into weekly cash payouts for investors. Here's why HOOY is so interesting. Robinhood has been one of the most polarizing stocks on Wall Street since its IPO. Love it or hate it, the company sits at the center of retail investing and fintech disruption, and that volatility creates massive option premiums. HOOY captures those premiums through covered call writing and hands them directly to shareholders in the form of weekly dividends. The numbers don't lie. Over the past year, HOOY has delivered annualized yields of over 70%, placing it among the heaviest payers in the YMAX family. That kind of income potential has caught the attention of dividend investors who want more than the slow trickle of traditional ETFs. Performance-wise, HOOY has benefited from Robinhood's rebound in 2025, with both capital appreciation and distributions pushing total returns higher. Even in choppier markets, the option income has helped cushion the ride, converting volatility into a steady stream of cash flow. The expense ratio is approximately 0.99%, in line with other YMAX products. Yes, it's higher than traditional funds like VOO or SCHD, but investors here aren't paying for plain diversification. They're paying for specialized weekly income strategies that few ETFs deliver. What sets HOOY apart is its tie to retail investor momentum. As long as Robinhood remains a key player in fintech and trading, the stock will remain volatile, and that means HOOY will continue to harvest premiums. For aggressive income investors willing to stomach the swings, HOOY offers a unique way to collect huge weekly payouts while riding the future of retail investing. If you're hunting for bold, high-yield plays in the weekly dividend ETF space, HOOY is a name you don't want to ignore. Let me know your take in the comments on which of these you are adding to your portfolio.